Now listen carefully, because this is where most traders lose their money. Not because they cannot read a chart, not because they lack intelligence, but because they cannot wait. Waiting sounds simple, doesn't it? Yet in the markets, waiting is the hardest work a man will ever do. You see, the market pays a man for patience. Not for activity, not for excitement, patience. I learned that lesson the expensive way. In the early days, I used to believe that money was made by constant trading. I watched every tick, every movement, every whisper of price. If the market moved even a little, I felt the urge to act. Perhaps you know that feeling yourself. The chart moves a few candles, and your hand starts reaching for the buy or sell button. You tell yourself, if I don't enter now, I'll miss the move. But let me ask you something. How many times did that impatience cost you money? The truth is simple. The market does not reward the man who trades the most. It rewards the man who waits for the right moment, the perfect entry point. Now, what is a perfect entry point? It is not a guess. It is not a hope. And it certainly is not a feeling. A perfect entry point appears when the market itself reveals its intention. The chart will tell you. It always does. Price moves in waves. It advances, it retreats, it pauses. Most traders stare at these movements and see chaos. But a patient trader sees structure. He sees accumulation, hesitation, and then the moment when the market shows its hand. That moment is the entry. But here is the part most men never learn. You must wait for the market to invite you. Let me ask you something. Would you walk into a poker game and throw your money on the table before seeing your cards? Of course not. Yet traders do exactly that every day. They enter before confirmation. They anticipate before evidence. They trade before the opportunity is mature. And when the trade fails, they blame the market. But the market was not wrong. They were simply early. I discovered long ago that being early is the same as being wrong. The market does not care about your timing intentions. It only cares about where price is right now. That is why the perfect entry point matters so much. Think about the difference between chasing a move and waiting for confirmation. When you chase, you are reacting to excitement. The market has already moved, and your emotions pull you into the trade. But when you wait for confirmation, you are acting with discipline. You let the market prove itself first. Which one sounds more like professional trading? You see, the real money is not made by predicting the future. That is a fool's game. The real money is made by observing what the market is doing and positioning yourself when the odds turn in your favor. A chart is not just lines and candles. It is the record of human behavior. Fear, greed, hesitation, confidence. All of it appears in the movement of price. And if you study it long enough, you begin to recognize certain moments. Moments when the market stops falling. Moments when buyers quietly step in. Moments when resistance finally gives way. Those moments, those precise points where hesitation turns into momentum, those are the places where trades should begin. But again, let me ask you something. Do you really have the patience to wait for them? Most traders do not. They sit in front of their screens for hours. They stare at the charts. And slowly, their discipline erodes. The longer they watch, the more they feel they must do something. Anything. But trading is not about doing something. It is about doing the right thing at the right time. And often that means doing nothing for long stretches. In my own career, some of my biggest profits came from waiting. Waiting while the market built its base. Waiting while weak hands were shaken out. Waiting while the trend revealed itself. Weeks sometimes. And then, when the market finally showed its direction, the entry was obvious. The breakout occurred. The volume increased. The price confirmed the move. That was the moment to act. Not before. The patient trader understands that the market is like a coiled spring. For long periods, nothing dramatic happens. Price moves sideways. It tests levels. It confuses the impatient crowd. But pressure builds. And when that pressure releases, the move can be powerful. Now imagine two traders. One trader enters early during the uncertainty. He hopes the breakout will happen. But hope is not a strategy. The market moves against him, shakes him out, and he exits with a loss. The second trader waits. He lets the breakout occur first. He sees confirmation. Then he enters. Who do you think has the advantage? The difference between those two men is not intelligence. It is discipline. Discipline to wait. You see, the perfect entry point is not about catching the exact bottom or the exact top. That is another illusion that traps many traders. Professionals do not need perfection. They need probability. If the trend is confirmed, if the structure supports the move, if the market shows strength, then the entry becomes logical. That is where the edge lies. But again, the market tests your patience. It tempts you constantly. You see a candle forming and think the move has begun. You see a small breakout and assume the trend has started. You tell yourself, this must be it. But the experienced trader asks a different question. Has the market truly confirmed the move? If the answer is no, he waits, and that waiting protects his capital. Remember, this capital is a trader's inventory. Without it, you cannot stay in the game. Every careless entry drains that inventory. Every impatient trade weakens your position. But when you wait for the perfect entry point, something remarkable happens. Your losses become smaller. Your confidence becomes stronger, and your trades begin to align with the market instead of fighting it. Have you noticed how the best trades often feel almost effortless? Price moves in your direction soon after entry. The chart behaves as expected. The trend carries you forward. That is usually a sign that you entered at the right moment. Not too early, not too late, just when the market was ready. But reaching that level of timing requires something many traders refuse to develop: restraint. Because the greatest enemy of the trader is not the market. It is the urge to act before the opportunity is ready. And that urge, it whispers to you every time you stare at the chart long enough. A perfect entry point appears only after the market confirms its direction. That is a principle many traders hear, but very few truly practice. You see, the market rarely moves in a straight line. It hesitates, it pulls back, it tests levels again and again. And during that hesitation, traders begin guessing. They try to anticipate the move before it actually begins. But the market does not reward anticipation. It rewards confirmation. Now ask yourself something honestly. How many times have you looked at a chart and thought, this looks like it's about to go up, or this must be the top? That little voice sounds confident, doesn't it? Yet more often than not, the market continues moving in the opposite direction, leaving the trader wondering what went wrong. What went wrong is simple. The trader acted before the market spoke clearly. The market always leaves clues in price. It tells you when buyers are gaining strength. It tells you when sellers are losing control. But those clues appear only after certain movements take place on the chart. A resistance level breaks. A higher high forms. A pullback holds above support. Momentum begins to build. Those are confirmations. A professional trader does not rush ahead of them. He waits until they appear. Let me ask you something. Would you trust a compass that had not settled yet? When you first place it down, the needle moves back and forth before pointing north. Only when it becomes steady can you rely on it. The market works the same way. Before a trend begins, price wobbles. It shakes out weak traders. It creates confusion. If you enter during that confusion, you are gambling. But when direction becomes clear, the trade becomes logical. Consider what happens when a market breaks above a strong resistance level. That level may have rejected price several times in the past. Sellers defended it. Buyers failed there repeatedly, but eventually something changes. Buyers push harder. Volume increases. Price pushes through that level and holds above it. Now the market has spoken. That breakout is not just a random move. It is a signal that demand has finally overcome supply. That is confirmation of direction. Now let me ask you this. Is it safer to buy before that breakout or after the market proves it can break through? Most traders buy before. They hope the breakout will happen. They want to catch the move from the very beginning. But hope is not a trading method. The experienced trader understands that missing the first small portion of a move is a small price to pay for certainty. He enters after the market confirms. The same principle works in a downtrend. A market does not collapse instantly. It shows weakness first. Support levels begin to fail. Lower highs appear. Sellers become more aggressive. Eventually, the price breaks downward with strength. That breakdown confirms the direction. Until that happens, The trader waits. Waiting may feel uncomfortable. It may even feel like you are missing opportunities. But patience is one of the trader's greatest protections. It prevents you from entering during uncertainty, when the market itself has not decided what it wants to do. And uncertainty is where most losses occur. You see, the crowd often trades during those uncertain moments. They buy because the price looks cheap. They sell because the price looks high. But the market does not move based on what looks cheap or expensive. It moves based on supply and demand. Confirmation shows you when that balance shifts. When the market confirms direction, momentum begins to form. And momentum is the trader's ally. It pushes price forward, sometimes farther than most people expect. But without confirmation, you are simply guessing which way that momentum will appear. Professional traders avoid guessing whenever possible. They let the market reveal the path first. And once that path becomes visible, the entry point becomes far clearer. Instead of asking, "What do I think the market will do?" the disciplined trader asks a different question. What has the market already proven? Entering too early is often the same as being wrong. That is a hard truth many traders resist accepting. They believe that if their idea about the market is correct, then their trade should eventually work out. But the market does not operate on eventual correctness. It operates on timing. A trader can have the right idea and still lose money simply because he entered too soon. Think about that for a moment. How many times have you seen a chart where you predicted the direction correctly, yet the market moved against you first? Maybe you bought because you believed the trend would go up. The market dropped before rising, stopped you out, and then continued exactly in the direction you expected. Frustrating, isn't it? But the market was not wrong, and neither was your general idea. The mistake was entering before the move was ready. Price rarely turns the exact moment you think it will. Markets take time to build momentum. They test levels. They shake out impatient traders. They create false starts and temporary reversals. All of this happens before the real movement begins. If you enter during that preparation phase, you are stepping in front of uncertainty. And uncertainty is expensive. Let me ask you something. Why do so many traders rush into trades early? The answer is not complicated. They want to catch the very beginning of the move. They want the perfect bottom. They want the exact top. It feels clever, almost impressive, to say you caught the market at its turning point. But the truth is, the market rarely rewards that kind of ambition. Trying to catch the exact turning point is like trying to grab a falling knife. Sometimes you succeed, but most of the time you get cut. The professional trader understands that catching the exact beginning of a move is unnecessary. What matters is catching the part of the move where probability is clearly on your side. That part appears after confirmation. When the market shows strength, when resistance breaks, when higher highs begin to form. That is when the trend starts to reveal itself. The move is already underway. Some traders complain that they are late at that point. But late compared to what? The beginning of a trend is not where the biggest money is made. The largest gains often occur in the middle of the move, when momentum is strong and participation increases. By waiting for that confirmation, the trader enters when the market has already proven its intention. Let me ask you a simple question. Would you rather enter early with uncertainty or slightly later with evidence? Most traders choose the first option without realizing it. They see a market approaching support and immediately buy, assuming the level will hold. But support is not guaranteed to hold. Sometimes it breaks. Sometimes price dips below it before reversing. When traders enter too early, they become victims of these small movements. Their stop-loss gets triggered. Their confidence weakens. And by the time the real move begins, they are already out of the trade. Entering too early creates another problem as well. It ties up your capital in a trade that has not yet proven itself. While you wait and hope for the move to develop, better opportunities may appear elsewhere in the market. Patience keeps your capital free. But impatience traps it. The disciplined trader waits until the market shows clear signs of movement. When buyers step in with strength, when price begins to move with conviction, when resistance gives way and the chart structure changes, That is when the trade becomes meaningful. Before that, it is simply speculation. You see, timing is not just about entering quickly. It is about entering when the conditions are right. A trade that begins at the wrong moment often starts with immediate pressure. Price moves against you. Doubt appears. The trade feels uncomfortable from the beginning. But when the entry occurs at the proper moment, something very different happens. Price tends to move in your favor soon after you enter. The market confirms your position almost immediately. That does not happen because you predicted the future perfectly. It happens because you waited for the market to reveal its direction before stepping in. Price action reveals intention if you learn to observe it calmly. That sentence may sound simple, but there is a lifetime of trading wisdom inside it. The market is always speaking through price. Every candle, every breakout, every hesitation tells a small part of the story. The problem is not that the market hides its intentions. The problem is that most traders are too restless to listen. They watch the chart with tension instead of patience. When a trader is anxious to make a trade, every small movement begins to look important. A few candles go up and he thinks the trend has started. A few candles go down and he thinks the market is collapsing. His emotions start interpreting the chart before the chart has actually revealed anything meaningful. Let me ask you something. Have you ever looked at the same chart later in the day and suddenly the movement looked obvious? The direction seemed clear, almost easy to understand. Yet earlier you felt confused and uncertain. Why does that happen? Because when you are calm and observing from a distance, the structure of price becomes clearer. But when you are staring at every tick, your mind becomes clouded with urgency. Price action is simply the record of supply and demand. Buyers push price higher. Sellers push price lower. The battle between them appears in the chart as swings, consolidations, breakouts, and pullbacks. If you watch long enough, patterns begin to form. Not magical patterns, not predictions carved in stone, just behavior. For example, when a market approaches a resistance level several times and fails each time, that tells you something. Sellers are defending that area. They are strong there. Price tries to move higher but cannot sustain the move. Now watch what happens if the market approaches that level again. If the buyers suddenly push through with strength and price holds above that resistance, the story changes. What once acted as a ceiling becomes a floor. That shift tells you something important about the intention of the market. It tells you that demand has become stronger than supply. But here is the key point. You must observe calmly enough to recognize it. Many traders miss these signals because they are focused on prediction rather than observation. They stare at the chart asking themselves, what will happen next? Instead of asking the more useful question, what is the market showing me right now? That difference in thinking changes everything. Observation requires patience. It requires letting the candles form, letting the structure develop, letting the market show its hand. When you observe calmly, small details become visible. The strength of a breakout, the weakness of a rally, the hesitation before a reversal. Those details are the language of price action. Now think about the traders who rush. They jump into trades during the early stages of a move. They assume the market will behave in a certain way because they want it to behave that way. But the chart may be telling a completely different story. For instance, a market might be rising slowly toward resistance with weak momentum. To an impatient trader, it looks like the beginning of a strong uptrend. But to a calm observer, it may look like a tired rally that is losing strength. The difference is not intelligence, it is patience. Calm observation allows you to notice when price accelerates, when it stalls, and when it changes character. Sometimes a market that was moving slowly suddenly breaks into strong momentum. Large candles appear, volume increases, pullbacks become shallow. That shift in behavior tells you that buyers are gaining control. Other times the opposite happens. A strong trend begins to weaken. Highs become less impressive. Support levels start to break. Sellers appear more frequently. The chart is constantly communicating these changes, but it does not shout them. It whispers them through price movement, and only the trader who watches with patience can hear that message clearly. The best trades usually feel easy because they begin at the right moment. That might sound strange to someone who is new to trading, because many beginners expect trading to feel intense and dramatic. They imagine the process as a constant battle with the market. Every trade feels like a struggle. Every movement feels uncertain, and every candle creates doubt. But experienced traders eventually notice something different. When a trade is entered at the right moment, the market often moves in their favor without much resistance. The position begins to work almost naturally. Price pushes in the direction of the trade, pullbacks are small, and the overall movement feels smooth rather than chaotic. Now let me ask you something. Have you ever entered a trade and immediately felt pressure? Price moved against you right away. The candles began forming in the opposite direction. You started questioning your decision within minutes. That kind of experience is very common when the entry timing is wrong. Entering too early places you in the middle of uncertainty. The market has not yet decided which direction it truly wants to go. Buyers and sellers are still fighting for control. When you step into the trade during that battle, you become part of the confusion. The result is stress. The chart moves up and down without commitment. You watch every candle closely, wondering if the market will finally move in your favor. Doubt starts to grow. Your attention becomes locked on every small fluctuation. But when the entry happens after the market confirms its direction, something very different occurs. Momentum begins to carry the price forward. Imagine a market that has been consolidating for a long time. Price moves sideways, bouncing between support and resistance. Many traders try to predict the breakout before it happens. They buy near the bottom of the range hoping the breakout will go upward. Others sell near the top expecting the opposite. Both sides are guessing. But eventually the market decides. Price pushes through resistance with strength. The candles become larger. Buyers step in with confidence. The breakout holds instead of failing. That moment changes the entire situation. If a trader enters after that confirmation, he is no longer guessing. He is moving with momentum. The breakout itself provides the energy that drives the trade forward. Now consider how that feels. Instead of watching the trade struggle to survive, you see price advancing in the expected direction. Pullbacks appear, but they remain small and controlled. The structure of the chart supports your position. This is why the best trades often feel surprisingly calm. It does not mean the market is perfectly predictable. No trade is guaranteed, but when the entry occurs at the right moment, the market and the trader are moving in the same direction. That alignment creates clarity. Many traders make the mistake of believing that difficult trades are normal. They think trading must always feel tense and complicated. But very often, that tension is a signal that the entry was poorly timed. A trade entered too early forces the trader to endure unnecessary noise. The market is still building its structure, still deciding its direction. During that process, price may move against the position several times before the real trend begins. Most traders cannot tolerate that kind of pressure. They exit too early, or they hold the position with growing anxiety. But when the entry is aligned with momentum, the market does much of the work for you. The trader is not fighting the trend, he is riding it. The movement of price supports the decision instead of constantly challenging it. Let me ask you another question. Which situation would you rather experience? A trade that immediately places you under pressure, forcing you to defend your position, or a trade where the market begins moving in your favor soon after you enter? Professional traders understand that the second situation usually comes from patience. They wait for the moment when the market reveals strength. They wait for the breakout, the shift in structure, the confirmation that buyers or sellers have taken control. Only then do they step in, because when timing aligns with momentum, the trade often begins with a sense of flow rather than resistance. Price advances with purpose, and the chart itself begins to support the position. Discipline in timing often matters more than prediction. Many traders spend years trying to predict where the market will go next. They study news, analyze indicators, listen to opinions, and build complicated theories about the future of price. They believe that if they can predict the market correctly, profits will naturally follow. But the market has a habit of humbling people who rely too heavily on prediction. You can predict the direction correctly and still lose money if your timing is poor. That is something many traders learn only after a long series of frustrating trades. They look at the chart afterward and say, "I was right about the direction." And sometimes they truly were, yet the trade still failed. Why? Because being right about direction is only part of the game. The other part, the part that quietly determines success or failure, is timing. Let me ask you something. Imagine you believe a stock will rise over the next few weeks. You buy it today because your prediction tells you the price should go up. But instead of rising, the stock drops for several days before turning upward. What happens? Your position goes into loss. Maybe your stop loss gets triggered. Maybe you exit because the pressure becomes uncomfortable. And then later, the market finally rises just as you predicted. Your idea about the direction was correct, but your timing was wrong. This happens more often than traders like to admit. Prediction creates confidence, sometimes too much confidence. A trader becomes convinced that his analysis is accurate, so he enters the market immediately, before the price action actually confirms the move. The disciplined trader approaches the situation differently. Instead of asking, "Where do I think the market will go?" he asks, "Has the market shown that direction yet?" That question changes everything, because once the market begins to confirm a move, timing becomes clearer. Support holds. Resistance breaks. Momentum begins to form. Price starts moving with strength in one direction. Now the trade is no longer based on prediction alone. It is based on evidence. Discipline in timing means waiting for that evidence. It means allowing the market to prove its direction before committing capital. This requires patience, because the market does not reveal its intentions instantly. It often moves sideways, tests levels, and creates temporary reversals. During that time, impatient traders begin predicting again. They assume the breakout will happen soon, so they enter early. They believe they are getting a better price by acting quickly, but that better price often comes with greater risk. When a trader enters before confirmation, he is stepping into uncertainty. The market may move against him, not because his idea is wrong, but because the move has not started yet. Timing protects the trader from that uncertainty. Think about a trend that is beginning to form. The first signals appear slowly. Price stops falling. Buyers begin to step in. Higher lows appear. Eventually resistance breaks and the trend becomes visible. At which point does the trade become more reliable? Not at the very first hint of reversal. At that stage the market may still continue downward. But once higher highs and higher lows begin to appear, the structure of the trend becomes clearer. That is where timing begins to favor the trader. Prediction tries to catch the move before it begins. Discipline in timing enters when the move has already started to reveal itself. The difference may seem small on the chart, but in trading results it can be enormous. Let me ask you another question. Would you rather enter a trade based on what you think might happen, or based on what the market is already proving? Most traders say they prefer proof, yet their actions often show otherwise. They rush into trades during uncertain moments, guided by forecasts rather than confirmation. The disciplined trader does the opposite. He allows the market to move first. He observes the behavior of price. He waits until timing aligns with evidence. A trader's edge comes from aligning with momentum, not anticipating it. That idea may seem simple at first glance, but it separates the professional trader from the impatient one. Many people approach the market with the belief that success comes from predicting exactly where price will turn. They want to buy the exact bottom and sell the exact top. It feels impressive when it works, and it creates the illusion of mastery over the market. But the market rarely rewards that approach consistently. Trying to anticipate momentum before it appears is like trying to sail before the wind begins to blow. You may set the sails perfectly, but without wind the boat will not move. In trading, momentum is that wind. Without it, price drifts, hesitates, and moves unpredictably. Now let me ask you something. Have you ever entered a trade because you believed a big move was about to happen, only to watch the market move sideways for hours or even days? You expected momentum, but instead you found stagnation. The trade went nowhere, and eventually impatience forced you out. That happens when anticipation replaces observation. Momentum cannot be forced. It appears when buyers or sellers begin to act with conviction. The chart shows it clearly when it happens. Candles become stronger. Breakouts occur with energy. Pullbacks become smaller because participants are eager to enter the trend. These are the signs that momentum is alive. But before those signs appear, the market is often quiet and uncertain. Traders who anticipate momentum enter during this quiet phase. They hope the move will start soon. But hope is a weak companion in the markets. Momentum must be visible before it becomes useful.